All right. Hi, everybody, and welcome to the live broadcast. I know it has been, it's been a minute since we've done one. So I felt like it was time to get back here in the studio and make sure that we just get back in front of you guys and share what's going on in the industry. There's been a lot that's taken place. We've been working on a lot of transition stuff. So we've been fairly busy ourselves, but wanted to kind of hit on some of the highlights, some of which you probably if you're in relationship with us, you've heard this. If you're somebody who's just finding us on YouTube, we're going to have a little bit of a talk about interest rates and how much money is that going to save you, or how much more house can you get for it. So we'll first talk about that. We are also going to start talking about short sales. In our area, we're seeing a small renaissance in the short sale arena. And we want to answer the question about whether that means market collapse, what are some of the signs to look for, and what else you should be concerned about, if anything, as we come into the election season in 2024 and then into 2025. So, and the last, we're also going to talk about compensation. Underneath the new rules from the NAR settlement, they are now in full effect. And there are people who are concerned about what these things mean. And there's some things out there that people are doing that are probably not exactly the right thing to necessarily do. So we're going to talk a little bit about that as well. For those of you that don't know me, I'm Jason Wilson, and I am the broker owner of Ursula and Associates. I'm excited that you took time to go ahead and connect with us. So let's first talk about those interest rates. So last week, the Fed decided to cut rates. The market was anticipating a 0.25% cut. So just as a small recap, how this works is when the market hears that the Fed is going to cut rates. If the Fed's saying, hey, our policies, we're going to be meeting a month from now, we think there'll be a rate cut on this, the speculative nature of what they just said will actually cause them to potentially for the market to rally. As the market rallies, rates already get better. In other words, it bakes in the discount. Because remember, as we've talked about before on this channel, the Fed rate is not the interest rate that you pay as a consumer. If that were true, the banks would not make any money. Why is that? Because banks are broke. It's one of my favorite things to say. They don't have any money. So what they do is they borrow money from the Federal Reserve. The Federal Reserve charges an interest rate on that money, and they charge a spread or a yield of more so that they can make a profit. For example, if the Fed fund rate was 5.5% and they needed to make 1% as an interest rate, then the mortgage rate would be coming at 6.5%, right? So that's that yield in between, meaning you're not going to see rates below what the Fed fund rate is. So the Fed said they were going to be cutting the rate. The rate was going to go down. The market already started to rally. So we saw rates start off this year at the 6.71 ish. Now, depending on credit or how much you wanted to pay in closing costs, if you rolled it in, you might have seen, sevens. And then as it began to soften on this new news, we saw stuff coming down to the 6.27. Some lenders I actually saw starting to lock stuff at 5.99, almost baking in the best case scenario of what could happen, meaning there's very little in their margin for them to make any money on this. When the Fed came out last week, they announced a 0.5 point cut, which was more than what the market expected. So you get a little bit of volatility with that. And now we're seeing somewhere around the 5.75. We do have some lenders reporting 5.625, just depending on what their margin is or how narrow their rates are going to get. We might see 5.5, I don't know. But right now, baseline 5.75. That's what we're seeing. So with that in mind, that's basically what rates are doing. How does that affect you? Well, let's just say it's at 5.75, and at the beginning of the year, we mentioned it was 6.71. Let's just say it was 6.75. That's a 1% rate. The 1% difference in the rate is equivalent to approximately $30,000 worth of buying power. Obviously, there's other factors involved in that. A higher priced house might have a different interest rate. Depending on the risk of the house, it might have a different insurance rate on it. All those things affect your payment. But generally speaking, $30,000. So if you're the buyer that has been out in the market trying and trying and trying and getting nowhere because everything within your maximum price range budget is way too much for you to fix, you might be able to spend a little bit more while still keeping that payment the same. If you were already pushing above your payment and you are finding things you like, but you're just nervous, even though you qualify, perhaps now you can actually go back out in that same price point, but your payment will be less. So those are a couple key features that you're going to want to think about when taking a look at whether now is a good time to buy for you. What I actually looked at is like bankrate.com, although that is not where I'm going to go recommend you go to look at stuff. It's not necessarily the best thing in town. But when I looked at it, their CEO and spokesperson basically said, we're in a high interest environment. We're going to remain in a high interest environment for at least the next year. So expect rates to float somewhere in this range. I don't know if we're looking at a full collapse of the rates. We are in what I would say is one of the most volatile election years that we'll have seen, at least in my lifetime. And so all bets are off, depending on what happens with the economy. But just remember, the economy and the market are cousins, but they don't hang out too much, right? So the stock market and the economy, although related, are not directly correlated with each other. Now, I'm not a financial advisor, and I'm definitely not giving you financial advice. But one of the concerns that we get is people looking for what is going to happen with the stock market, meaning it's going to create an economic collapse. One can affect the other, but it's not a direct correlation. You're not just all of a sudden going to see the stock market implode and the economy implode at the same time, although you might see sectors of it do that. If the economy implodes, that doesn't mean every area of the stock market would implode at the same time. They have an inverse relationship with each other, but there are certain segments that end up doing well regardless. If, for example, money starts going into non-petroleum based energy solutions, which it has been for a while, but let's just say that based on the results of the election, it goes heavy that direction, then companies like Tesla or other things might go up in value because they're EV solutions, and that's where the government dollar is pushing. Well, you might see a decline in other areas because of those, those inverse relationships with stuff. You have to look at the fact that interest rates coming down is really a good bonus for you. However, it makes more buyers come into the market, and we still have a low inventory. So prices of houses can still get expensive. So if you're in the market and you're thinking about buying, you're definitely going to want to talk with us. If you've been considering selling, well, there might be more buyers for your house right now. So if you're one of those people who's looking to relocate out of an area that maybe you bought in that you aren't a huge fan of, then go ahead and give us a holler and let's see if that math makes sense, right? To be able to do it. If you're living locally and you're just simply like paying 6% rate and you want to refinance to 5.75, I'm going to tell you to wait. All right, so let's go ahead and move into the short sale conversation. So short sales are what happen when somebody becomes distressed. They need to sell their house, or they're relocated to another area where they can't sell their house because they're either underwater due to its condition, or they simply owe too much money that they can't afford to pay real estate professionals unnegotiated compensation to be able to put it on the market and procure a buyer for them. As a result, what ends up happening is they're put into a position. So let's talk about first who might find themselves in that position. So one could be somebody who had a house where something happened to the house. And let's just say there wasn't enough insurance on the house to cover what happened, or whatever happened isn't covered by insurance in general. Then what you run into is, okay, I now have this, I'm going to make up a number, $15,000 repair on this house to really bring it up before anybody's going to want to buy it. As a result of that, I don't have the money. So now I'm in a position to have to sell as is. And I did a down payment assistance program. So I borrowed 100% of the money for the house. So I might find myself underwater having to do it. Those are the ones we're starting to be able to see, is the ones that put down a minimal down payment, or they, I guess it's a minimal down payment or no down payment whatsoever. And in areas where they might have paid way more than what the appraisal is. So remember, if you want to survive those types of shift in a market, work to not be in a position to have to sell. If you find yourself in a position to have to sell for some unknown circumstance. So I'm basically making a distinction between the people who are like, I think I want to sell. This isn't going to work out. Let me just get out of this, versus the ones that have to because there's health, life, safety, family, work, something that you cannot avoid. And then you find yourself in that situation. So we're seeing a handful of those. I've had several real estate agents that do business with Thomas and Brown have reached out to either Mark Brown or Lon Thomas. They've told them to call me to see what needs to happen. And we're trying to walk people through some of that. We have a couple listings ourselves that are short sales that we are trying to do. Both of those were in positions where they either did a down payment assistance program, so they didn't have any money down, and something happened that was outside of their control. And so we're having to put the houses on the market to try to find them a buyer for that house, which has now resulted. There was enough money there to get the job done, but as time has gone on and the house sits vacant and the market has softened a little bit, it's now put us firmly into the short sale territory. So if you're seeing those type of situations and you want to buy one, it's time for a refresher course. One, when you make an offer, it can take 1 to 3 months. I should say 1 week to 3 months before you're likely going to get a counteroffer from a bank, depending on the agent doing the short sale and how much of the documentation they've had in. In our cases, we've been seeing initial responses within about 7 days. And then generally speaking, they have an inflated value of what they think the house is worth. Then we have to push back. Then they ask for more comparables, and another 7 days ensues in that cycle until we can get to a result. So that's what's out there right now. The third thing we wanted to cover on this live broadcast is the changes in the industry. This is a big deal. The changes in the industry from the NAR settlement. Want to talk about what that looks like, especially to you, the consumer, in case this is a concern for you. For some of you, it's become a big concern. And for others, it might just seem like business as usual. So here are the major changes and what they were trying to accomplish with this. The Department of Justice wants the cooperating compensation between a buyer's broker and a seller's broker to not be tethered together anymore. That's kind of one of their primary things that they were looking for in this settlement. What used to happen is a listing agent like myself would come in and negotiate with the seller a price and a certain amount of compensation, which, by the way, has always been negotiable. It's always been negotiable. One of the accusations in the lawsuit is it was not negotiable. It was required. It's not required. You can say you'll offer me 0, and I have the right as a negotiation person to say, I appreciate your offer and I'm going to pass. I can turn around and say, I would like you to pay 6. And you can say, I'm not willing to pay 6%. I'm willing to negotiate a 5. And if I think it's worth it, I might say yes, or I might say no. So it's always been negotiable, but we would negotiate an overall compensation package, which we used to call commissions. Then we would offer to co-op or share a portion of what we were going to earn with any other agent who brought a buyer. Well, because some states had it as a requirement, and because of some of the things that NAR had in terms of clear cooperation and requiring $1, it put us into a position where they said it wasn't negotiable, even though it's always been negotiable on our end. As a seller, you always could have offered 0. So in compliance with the Department of Justice, what they're looking for is now on our listing forms, when we come in, we say, this is what we're going to charge for our portion of the service. And if you would like to offer any compensation to the buyer side, you can. You don't have to. And if you choose to, my brokerage, me as the broker, basically says that you're offering that directly to the buyer's broker. So before, it was you were offering it all to me and I would share a portion of it, which is the coupling part we're talking about. Now it's you're offering it directly to them. I'm not even inside of it. It doesn't come through me. It's not owed to me. I don't share it with them. You're just paying them directly. By doing that, we're uncoupling those. So 2 key points. 1, it's negotiable, as all things are. There are no set fees. 2, you're paying the listing broker directly and you're paying the buyer's broker directly if you choose to offer compensation. So those are the 2 big ones. Now for buyers, so that's a bunch of semantics and moving math around to some degree. Where the big effect comes in is with buyers. Now underneath the settlement, myself as a buyer's broker, in order to take somebody out and show them a property, I must have a signed agreement with them clearly stating what type of compensation I charge. That is open for negotiation. I could come in and say I charge between 3 and 4%. You can say I want to pay you 1%, and we negotiate it out and we settle at 3%, or we just decide that this isn't a fit. It's kind of like a car lot. You go in there and you say I'm willing to pay this, and they say this is the best I can do, and you either do it or you don't. So we go through the normal cooperation or the normal negotiations of that, and then we all of a sudden get into the situation where we say, okay, I'm going to give an example. Our compensation is 3.25%. That's what let's just say in this hypothetical scenario that I have negotiated with this buyer that we're going to get paid. I have to clearly state that he or she, they are obligated to pay that amount. Now, because of this rule change, what I'm able to do is in every property they're looking at, when we make an offer, we get to ask, what is the compensation being offered by the seller for the buyer's agent? Whatever that is, we would subtract from that 3.25%. And if they're not offering anything, or if they're offering less, in the offer, there's now a form where we can put in there saying, hey, we are willing to pay X dollars for your property. And as part of that, you, Mr. Seller, need to pay my buyer's broker 3.25%, thereby eliminating the buyer's obligation to pay any more. Now, as a buyer's broker, I'm only able to collect whatever that amount is. So let's give a different example. Let's say in this example that we negotiated out a 3%. And then I go in and this seller is offering 3% plus a $10,000 bonus on the sale of this property to any buyer's broker. Because I negotiated a 3%, I'm not entitled to the $10,000. Therefore, even though he's offering it, I can't accept it unless, of course, the buyer agrees and we're able to put that back together. So whatever's negotiated is what has to be. What this changes is any real estate agents out there saying, I'll take whatever they're offering. If they're offering 1%, 2%, 3%, my services to you are free. Those are not words you want to be saying. It was very clear that with this NAR settlement, that is what they wanted to stop. They do not want you doing that. They don't want you saying it's, your services are free. Now, where this creates some good news for the consumer is one, every buyer's agent that was in the marketplace that couldn't articulate the value that they bring to the table, and they're uncomfortable telling you this is what they're going to charge. They don't understand that if they agree to 1% and the seller agrees to pay 3%, they can only have 1%. You lose the lower skilled and you get the better skilled. And believe me when I tell you, and you can ask several people I know who had choices to work with me and other agents. And in the cases where they didn't end up working with me, on some instances, they came back and said, hey, I ran into this problem. And some of them lost $10,000, $15,000 worth of earnest money that we would have been able to protect them against, but they chose to work with somebody that was offering a discount. Not saying, well, first of all, let's erase the word discount. They were offering to do it for a negotiated lower price than what we were willing to do it for. So the difference between the two being one less than us, therefore discounted, although there is no standard. So in that particular instance, and this is not always the case, because you can find somebody that you negotiate 1% with, and they might be the most skilled person on the planet. But in this particular instance, it was somebody who had less skill, less experience, and therefore they find themselves in trouble. And what they would have had agreed to have paid what we were offering, they lost way more in the earnest money that disappeared. So it ended up being far more expensive to go the other direction on that. So that's one of the things. The big issue that I don't know what's going to happen is the fair housing issue. And so we're going to conclude this segment with this. If you have first-time home buyers where the down payment assistance programs exist for, they have zero to limited or a limited amount of money. Let's just say they're a veteran and they've got $5,000 for their closing costs, and that's it. When they have to go in and a seller is not offering any compensation, and they have agreed to pay a real estate agent a certain amount of compensation, and they go in and negotiate, that buyer's agent is going to say, hey, pay the buyer's broker this much money. If the seller's like, no, 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 well, then the buyer just can't buy the house because he doesn't have enough money. It's kind of like saying your lender's approved you if you put down 50%. It's like, well, I don't have 50%. Well, then you're not approved, right? So I'll accept your offer, but I'm not going to pay the compensation that you agreed to pay the real estate agent, might mean that they have to pass up on a deal. Right. And so that's one of the catch 22s. Now, I'm not advocating that any real estate agent should work for free out there. The old system provided a little bit of a better way of communicating this. And so there is a possibility that we'll have a few issues on that. However, I think if a seller wants to sell and a buyer wants to buy, and there's not 9 buyers lined up in those situations, and they need to make that work by paying that compensation, I think they'll find a way to work it into the deal. The biggest ones that are going to be a concern is for those that don't want to sign agreements before they go and look at properties. Real estate agents that are just opening the door without a signed agreement, it's a problem. Now, if you're somebody who I showed a property to and you're like, hey, wait a minute, you did that. Well, it was my listing. I work for my seller, and I'm obligated if if an unrepresented buyer contacts me and says, I'd like to see this property, and they're not interested in negotiating a compensation structure, I am able to show my seller's house to that individual. Now, if they say I want to go through 3 more houses, we have to sit down and agree on what that compensation looks like. I can't go open doors for you wherever you go, but I am allowed to show my own listing. And so that's one of the key differences. And this barrier to entry, we're going to see one of 2 things. Either you're going to see a lot of realtors breaking the rules, and then you've got an attorney out there going, we'll be watching you, which is the creepiest damn thing he ever could have said. But there you have it. So this is the attorneys that, filed the Sitzler Burnett case. They accused the real estate agents of fleecing people. And so they wanted to protect them. And so they basically billed the industry like $10 million to protect those people who are now going to get like $500 for the efforts. Who's fleecing who? That being said, what we run into in this scenario is you're either going to be not abiding by the settlement and the rules that are in there as a real estate agent, or you're going to follow the rules because, hey, we will follow the rules 100%. Doesn't mean I have to agree with it. Doesn't mean I have to agree with his motives and the ideology behind it. We just have whether the law makes sense or not, we will follow the law. That being said, that means some buyers that don't want to sign anything can't get access to a property. So where's that going to go? Anyway, so that's some of my thoughts. We'll be continually talking about this as far as in the market and what you're going to see out there. If you are in the market and you want professional representation from people who sell millions of dollars worth of property every single year, where they're going to protect your earnest money, they're going to negotiate on your behalf, they're going to operate with ethics and actually follow these new rules in the law while trying to get you the best outcome with the least amount of hassles, give us a call. You'll see us in the number below. We'll look forward to speaking with you. Hope you guys have a great day. We'll talk to you soon.